Good afternoon, everyone. This is John Cornwell from Plunkett Cooney's Practice Development Department. It's my pleasure to serve as coordinator for today's webinar, focusing on the Employee Retention Credit Program, where the program stands today and what businesses can expect from the IRS as it navigates the closing stages of the program over the next 12 months. The IRS is signaling that it's preparing to audit a large number of program participants due to potential widespread fraud and abuse. And the IRS is also instituting new policies and procedures that fundamentally change the way the program will work in the future. So joining us today to guide us through this complex topic, I'm happy to say, is Joe Peterson from Plunkett Cooney's Tax Law Practice Group. Now, before we get started, I'd like to take just a few moments to provide you with some background about Joe and our law firm. For those who don't know, Plunkett Cooney is based in Southeast Michigan and is one of the Midwest's oldest and largest law firms with approximately 130 attorneys. We have 7 offices in Michigan, as well as offices in Chicago, Illinois, Indianapolis, Indiana, and Columbus, Ohio. The members of our tax law practice group provide an array of services from business tax controversy and tax planning to personal tax controversy and issues related to state and local taxes, including commercial property tax appeals. And at this time, I'll introduce you to Joe. For nearly a decade now, Joe Peterson has worked with businesses and individuals to address their tax law needs. He has particular expertise related to today's topic, the Employee Retention Credit Program. And he routinely advises and represents clients in virtually all facets of tax law, including personal and business tax controversies. He also helps his clients resolve their individual and business tax issues with the IRS. It's saving them millions of dollars in tax liability along the way. Now for a couple of housekeeping notes about today's program. For the Q&A portion, the question and answer portion of our webinar, we're going to use our questions window on your GoToWebinar navigation display. If you could take a moment now to locate that window, you can feel free to enter questions as they occur to you throughout the program. I always add one caveat that when asking questions, please keep them somewhat generic or general so that we're not giving away any proprietary information or specific information about you or your company. And we, at the end of the program, will answer as many of those questions as time permits. Finally, I want to mention that today's session is being recorded, and that recording will be available on our event page on Plunkett Cooney's website, which is located at www.plunkettcooney.com. So feel free to share a copy of that link to your colleagues, or if you want to revisit this program in the future, that recording will be there for you. So thanks again for attending today's webinar. Now at this time, it's my pleasure to introduce Joe Peterson. Joe, please take it away.
Thanks a lot, John, and thank you for joining us for today's webinar. So I wanted to start the webinar today by giving a brief description of exactly what the Employee Retention Credit is and kind of the historical timeline of where we were at previously with the program and where we find ourselves at today. So just as a brief background, the Employee Retention Credit, or ERC, is a pandemic-era program that was created as part of the CARES Act. And for those of you who remember that far back, the CARES Act is a pandemic-era program that really began around March of 2020. And as part of the CARES Act, Congress also created what was called the Paycheck Protection Program, or the PPP. Both those programs were initiated to really support businesses in particular who at that time were really struggling with the impact of the pandemic, specifically with regards to their staff in general, exploding costs, inflation, all of those different things that in some cases we're still dealing with the consequences of today. So as part of the CARES Act, Congress created the PPP and really gave businesses the option at the time in 2020 to pick between either program. The PPP is a program that is designed to allow businesses to receive a loan based upon their payroll in the past and to convert that loan into a grant if they meet certain conditions. The ERC, on the other hand, is a program that is designed to incentivize businesses to retain employees on their payroll and then to credit them for wages that they pay over a period of time. And that distinction is important because the way that the programs were administered fell into two particular camps. The Small Business Administration, or the SBA, administered the PPP. The ERC was administered by the Internal Revenue Service, or the IRS. The ERC in particular covered the 2020 and the 2020 tax periods, or tax years. As I mentioned, the ERC was available for businesses who met certain qualifying criteria that we're going to talk about later on, and it reimbursed them for wages that they paid, provided that they met that qualifying criteria. But what's important to note here, and we'll go over this in a lot more detail in a moment, is that the ERC itself as a program, while it's simple in terms of how it's outlined in the CARES Act, is a very nuanced program. There are a lot of nooks and crannies and different rules that have to be navigated to effectively go through an ERC calculation and then, of course, file for the credit itself with the IRS. It's important to talk about the ERC at this time, and the reason that we thought it would be good to do this webinar because as the program moved through the 2020 and 2021 tax years, and then the pandemic sort of, I guess, wound down for all practical purposes, and we entered into the 23 and 24 tax years, the IRS began to become much more active with regards to the ERC and the different things that they were seeing on their end. And so what this slide here illustrates is one of the news releases that the IRS has provided or has issued over just this last quarter. The IRS has been very active, in particular with the ERC, and has been publishing almost bi-weekly different news releases related to its activities and programs that it is initiating to begin to try to address the ERC as the program winds down into the near future here in 2025. So in the next slide, we're going to talk about the two qualifying tests that kind of make up the ERC itself. So we talked initially about the ERC and how it is reimbursing businesses who retained employees when it could have been easy to lay them off during the pandemic, during the COVID era there. And the ERC itself uses two primary tests for the purposes of qualifying a business for this particular credit. The first test is the full or partial shutdown test. And what this test effectively does is it looks at the executive orders that were issued primarily by the governors of the states where these businesses reside, but also can be national or federal executive orders as well, or mandated orders. And it determines whether or not that business had a full or partial shutdown to its operations that were non-nominal in their impact. So by operations, what I mean is, if you have a restaurant and you have a lot of indoor seating and the pandemic hits, and if you're in Michigan, everybody remembers that we had all those kind of snow globe looking things where people would go and they would eat, but it would be outside and it was very limited. And if you went in, you could only pick up an order and you could leave. Well, that kind of thing is an impact in the operations of that particular restaurant, because of course restaurants primarily derive the majority of their business through sit-down guests. So that would be an example of an executive order that was issued by the governor of Michigan that specifically fully or partially shut down restaurants. Non-nominal, the test for non-nominal is that the impact needs to be greater than 10% of the revenue of the business. And there's a lot of ways to kind of, parse through that. For the purposes of this webinar, we won't get down too deep into the nuance of how these particular tests are applied, but the general idea here is we're looking for a business that was impacted due to executive order that was mandatory in nature, not a guideline, and that did not shut down voluntarily, and then suffered some sort of a full or partial impact to their operations. The second test is the gross receipts test. The gross receipts test asks that the business look at their 2019 gross receipts, which is what the IRS considered to be the last good year prior to the pandemic. And in assessing 2019, if we were doing the calculation, we would compare each quarter with the same quarter in 2020 or the same quarter in 2021 to determine if there was a significant decline in those gross receipts. Provided that decline occurred, then the business would qualify for the employee retention credit during that period. So what's an example of that? If I were to look at quarter 3 of 2019, I would compare that same quarter to quarter 3 of 2020 and determine if there was a drop. So if I had $100,000 in gross revenue in quarter 3 of 2019, and then I had $35,000 in gross revenue in quarter 3 of 2020, well, that's obviously going to be a drop of greater than 50%, which is our threshold for 2020. And as a result, the business would qualify for quarter 3 and also for quarter 4 for that matter, based upon the rules of the ERC and the gross receipts test. So that's effectively what we would do. The decline we're looking for in 2020 is a 50% decline. The decline we're looking for in 2021 is a 20% decline. So, again, you're comparing 2019 with 2020, and then you're doing the same thing with 2019 and comparing it to 2021 to determine whether or not the business qualified based on the gross receipts test. Now, there's an important caveat to that particular test that impacts 2020 in particular, which is to say, if the business it dipped below the 50% threshold that was in place that you would use to qualify under gross receipts, and you did that in quarter 2 of 2020, but then the business never got back above 80% through the remainder of the year, even if it got above 50%, so say, the decline was only 40% for quarter 3 and quarter 4 of 2020. Well, the business would still qualify for quarter 3 and quarter 4 of 2020 based upon the continuation rule that is in effect for the ERC. And I bring that up because it's an important example of the nuance of the program. So when I talked earlier about how the CARES Act kind of outlines some of these different things and lays out the program itself, this is an example of something that is not contained in the CARES Act. This is guidance that the IRS provided that is very specific to this particular test that, it's an area that you can miss or get wrong that would cause your ERC calculation to be incorrect. So next, we're going to talk a bit more about the credit itself and what it looks like in terms of what the refund is for employees. So what we're looking at here, so the ERC is driving, the credit itself is driven by headcount in particular, and it's driven by qualified wages that are paid to employees that a business has retained during the qualified periods that we talked about earlier, and that hopefully we would have identified using those 2 primary tests. So to step back for a moment, qualified wages, in terms of what would count towards this particular ERC program, are wages that are going to be paid to your W-2 employees. So that means if you have W-2 employees, their wages and any qualified health expenses that the employer specifically pays, as well as contributions to retirement plans, again, must be employer, not employee, but employer paid, can be used to qualify for the ERC. Now, what's important to note here is if you have a 1099 employee or employees, those individuals, their wages will not count towards the ERC. So that's another important distinction here with regards to calculating credit. There is additional tests that go into, and I should step back for a moment. So the credit itself is calculated on a yearly basis in 2020. It's calculated on a quarterly basis in 2021. What do I mean by that? So if I have an employee who earns $10,000 or greater in wages for the year in 2020, that employee can qualify for up to $5,000. So essentially, you would be dividing that $10,000 number by 50%. That's your maximum credit. So even if you didn't hit that $10,000 mark, you'd still divide by 50%. That's the eligible credit for that particular employee. And as I said, it's calculated on an annual basis for 2020. 2021 is a little bit different because in 2021, we are calculating on a quarterly basis. So, and the credit increases to $7,000 per employee. So what does that mean? That means that I am looking for $10,000 to be paid to each employee, provided I have $10,000 in quarter one of 2021, for example. That employee would be eligible, or the business would be eligible to receive a $7,000 employee retention credit for that particular employee. But you can do that on a quarterly basis, which is different than what you would see in 2020, where the calculation was done on an annual basis. So if you do the math there, you kind of add everything up, you can receive up to $21,000 in a credit for 2021 and $5,000 in a credit for 2020 for each employee. So if you do the math there, it becomes, you kind of see very quickly how there is an opportunity for businesses who qualify for this particular credit to kind of recoup a pretty sizable amount of money for these employees on a very easy basis or very quick basis, just based upon wages that they take. But again, you have to exceed that $10,000, meet or exceed that $10,000 threshold. So depending on what kind of business you have, that may not be particularly easy. So if you go back to the restaurant example I used earlier, restaurants have a lot of part-time employees or seasonal employees, or folks who really aren't putting in 40-plus hour work weeks, or certainly aren't on salary. Restaurants have a difficult time hitting that maximum threshold to maximize their credit, simply because they don't have the wages to support what would be needed to qualify across the entire period, assuming, of course, that they qualify in the first place. So, that's another area of nuance that can be a little bit misleading. Yes, the maximum credit certainly is $26,000, but can you hit it easily? Well, maybe. That's the answer, is going to be maybe. So I also wanted to talk a little bit about the ERC and the PPP and their relationship. I mentioned this earlier in terms of how they worked when I was talking about the historical kind of origin story for the ERC and the PPP being in the CARES Act. But in the CARES Act, Congress was scrambling at the time. If you think back, a lot of things really were in disarray. And so Congress, they did not allow businesses at that time to do both. They asked businesses to choose one or another. Well, of course, because there was so much uncertainty at that time, many businesses chose to do Paycheck Protection Program or PPP loans. They did that because it was the quickest and easiest way to get capital, which many businesses needed desperately at the time, without having to wait around for the IRS to process returns or do whatever else. And there was no real calculation to do. You could call your bank, you could get it done, over the course of a week or less. So a lot of businesses did a PPP, and they did not do an ERC back then when faced with the choice. Well, all of that changed in November of 2021. I'm sorry, November of 2020. In November of 2020, Congress changed its mind and allowed businesses to do both. And so at that time, there was a very rapid uptick in the amount of businesses who, having applied for PPP funds, then turned back around and also availed themselves of the ERC program at the same time. But there's something important here that I highlight in this slide that has to be, kind of addressed, which is that both programs, when we're talking about acquiring PPP forgiveness, so remember, you receive an initial loan and you use the loan towards wages and qualified non-wage expenses like rent, utilities, and so on. That's the idea behind the PPP. But qualified wages is going to be the primary driver. Well, the ERC is the exact same thing. You're going to use qualified wages as the primary driver to compute the amount of credit that you can receive, provided that you qualify for the program. Well, like anything else with the IRS prohibits businesses from double counting or double dipping using the same, kind of line item, as it were. In this case, because qualified wages are the driver for both programs, this is where the difficulty with doing the calculation really kind of comes into play, especially for businesses, many of whom had done both. You have to back out, a business would have to back out wages that were used to qualify for PPP forgiveness from their calculation when determining what the credit would be for the employee retention credit. So that's I keep bringing up nuance. It's another one of the nuances of the ERC as it relates to the PPP. So I talked about this earlier, so it's a little bit redundant at this point, but the idea is if you're a business and you have a PPP already, you may have done the first round, you may have done a second round. I should back up and explain that too. So the PPP was offered in two separate rounds. The first round occurred in 2020. The second round occurred in 2021. Businesses could apply for both. They could apply for either. Many businesses did in fact receive both. If you had that PPP, what the goal was, you didn't want to have that PPP become a loan. So in doing your ERC calculation, it would be important to allocate enough wages to fully forgive or have the PPP loan fully forgiven, and then use the remainder towards the ERC. And it's important to note here, I have on this slide that because, as I mentioned earlier, the SBA handled the PPP and the IRS handled the ERC, we don't have any evidence at this point to suggest that those two agencies are communicating with regard to which qualified wages are being used for which program. It's unclear how that will work in the future. I mean, obviously, you can't double dip, but these are two radically different agencies doing radically different things. So it's important to note that there's that kind of disconnect between the two, and that's going to be one of the things that the tax practice here at Plunkett Cooney in particular is going to be monitoring into the future. So let's talk more about the ERC itself and what a business or an accountant would do to calculate the ERC. And before I do that, I just want to mention the ERC right now is still around and kicking. It is in its fifth year right now, but it is still something that, technically speaking, businesses can still apply for. That is not the case for the PPP. The PPP has been gone since 2021, but the ERC is still, for now anyways, still around. So if a business came and wanted to do an employee retention credit qualification, well, what would they need to do? There's a few pieces of key information that they would need to have to begin. The first is their 941. And for those of you who are not familiar with a 941 is, a 941 is a tax document that employers, businesses are required to file on a quarterly basis with the IRS. And it has some important information in there. It primarily will contain your wages and tips that are paid to employees. It'll show Social Security wages, Social Security tips, and then also Medicare tips. And the idea is that your wages are multiplied against a factor that determines how much deposits should be made on behalf of your employees. And then you file that form with the IRS, you send in your deposits, and you kind of move that from quarter to quarter. The due date for a 941 is 30 days after the conclusion of the quarter. So if we're talking about quarter one of 2024, we just got done with that, obviously. The due date would be at the end of April for quarter one of 2024, 30 days after the date. So you would need to gather your 941s for 2020 and 2021. So, you'd have to have those for the periods that the business qualified for the ERC. The next thing that you would need is W-2 wages broken out, typically by pay period for each employee. Why do I say by pay period? Well, if you have it, your wages grouped annually or even quarterly, you're not going to have the level of detail or specificity to be able to pull them apart. And one of the things that is important about the two qualifying criteria that I didn't mention earlier that I think is important to mention now is, if you qualify based upon the Florida partial shutdown test, that qualification period is going to run from the date that the business was shut down to the date that it reopened. So again, using my restaurant example, if we look specifically at that, in Michigan, restaurants were shut down on March 16th of 2020, and they didn't reopen until June 22nd of 2021 in Michigan. So if you're a restaurant in Michigan, you can qualify based on shutdown alone within that time period. Well, any wages paid past June 22nd of 2021, those wages won't count for the purposes of the ERC. So, that's an important thing to distinguish between the gross receipts test, which is done on a quarter by quarter basis. So you have to have that level of specificity with regards to the wages that you have for your employees. And then you also need to know the employer paid portion of the health insurance and 401k contributions. And then you need to aggregate the ownership interest for the business. So there's a couple of key elements that come in here as well, specifically to do with ownership. The first is if you are an owner of a business and you own the business greater than 50%. So if you own it only 50% and you have another 50% partner, this doesn't apply to you. But if you own it 50% or greater, then your wages or any wages of close family members of yours are not eligible for ERC. That's the first thing. And then the second thing is, if you own more than one business, for the purposes of qualification, we have to consider all those businesses in one control group, which can be a good thing too, because if you have multiple businesses, say I've got 2 businesses that wouldn't normally qualify, but then I have a restaurant. Well, because they're part of the same control group and they're owned by the same people, the fact that that restaurant qualifies is going to cause the other 2 businesses to qualify as well. Again, we're going to get back to the idea that this is a nuanced program, and this is another example of that. So we have to aggregate those businesses. We have to remove wages to owners and their family members. We can still use those wages for PPP forgiveness, but for the ERC, they are non-factors. And then we also have to determine if the business was a recovery startup business. A recovery startup business is a business that was started after February of 2020, and then it also cannot in any way, shape, or form have qualified for the regular ERC. Not any period, not at all. If that's the case, then that business can qualify for Q3 and Q4 of 2021 specifically, but then it has a smaller amount of credit that it can receive. So those are the first things that have to be done as kind of part of the ERC calculation process. Once that process is done, you've added in all your employees, you know what your wages are, you know what your credit's going to be. You have to break it out by quarter, and then what you're going to do, what a business would do, is amend their 941 returns. So remember, these are historical returns. They are returns that we filed back in 2020 and 2021. You've already made your deposits. You should, if you've paid your deposits on time and appropriately, have a zero balance. Well, to claim the ERC, the IRS has directed that businesses file 941X amending returns with the IRS for each quarter that they are claiming the credit. They're going to claim a non-refundable credit first, which is a returning of all your Social Security deposits. And then anything above and beyond that is going to be refundable, which is going to be the total credit itself. That's essentially what the mechanism is. If you look on a 941X, you can kind of see the individual line items for the ERC credit in there. So when the IRS receives those 941X forms, they are not conducting due diligence other than to say that they're comparing to make sure that the wages on the 941X are not in excess of the wages that were initially claimed on the 941. If that were the case, then the business can certainly increase or amend those wages, but then of course they'd have to increase their deposits to reflect the new wage totals as well. And that of course isn't typically something that happens. So other than double checking wages, historically there was no due diligence. That was a policy concern that was done by the IRS specifically to get money into the hands of businesses as quick as possible. But it's a misnomer, I think, that a lot of businesses assume that because their claim was paid, that the IRS approved it across the board and then done their due diligence. And that's just simply not the case historically based upon what was done with prior claims that were processed by the IRS. So following that, businesses would need to amend their income tax returns to back up a payroll deduction because, of course, similar to qualified wages, you can't double count a deduction that you would use towards a credit. You can't also have a deduction for it on your income tax return. And then, of course, on this slide here, I also mentioned the deadlines to file. So 2020, an ERC for 2020, the deadline already elapsed. It would have been April 15th, so a little bit earlier this month. And then the credit, applying for the credit in 2021 is set to lapse on schedule on April 15th of 2025 of next year. So this is where we kind of get into the interesting part of this webinar and why I felt it was important to kind of talk through the ERC itself. And that is that a funny thing sort of happened about midway through 2021, which is that a lot of third-party providers really started to understand that there was an opportunity here, at least in their minds, to claim this credit and to do this work. And you didn't have to necessarily be, I guess minds can differ on this, of course, but it was possible to have no background legally or in accounting and still do employee retention credit claims for businesses. And so what started to happen in the ERC space from that time through today, as a matter of fact, is the rise of third-party providers. And these third-party providers were extremely aggressive. There were many of them sent out mailers. They were appearing in commercials. There were radio and TV ads. There were emails. One that was memorable to me was that during the Final Four, there's a guy on Shark Tank named Kevin O'Leary who had his own ERC processing business. And he, of course, had an ad during the Final Four that many people would remember. So, the ERC kind of crossed the threshold at that point, right? I mean, when you have a guy like Kevin O'Leary, who's a Shark Tank participant, who's also starting an ERC company, then it tells you the level of third-party pervasiveness into that space and the amount of profits that were being generated by these third parties. So, I was seeing from different clients of mine who were contacting me at the time, contingency fees on the refunds received by the businesses that the third parties were charging that were as high as 50%, which is absolutely outrageous. I mean, there's certainly a means to be paid adequately for your work, but 50% ratio, a contingency ratio, is certainly not what Congress's intent was when they passed a program like the ERC to help struggling businesses out at the time. So, and like I mentioned, there's really no connection from these third parties to attorneys or CPAs or bookkeepers or really anybody with professional backgrounds. It was not uncommon for me to see third-party providers who were former mortgage companies or who were involved in other credits maybe, or really had no basis for doing these claims who were processing them. And typically the arrangement was that these third parties would do a calculation. Again, it's not necessarily clear how they did that. They would enlist a CPA firm or bookkeeper who would do returns based upon the numbers provided by that third-party provider, and then they would provide them to the business to file. And the business would either have to sign them, so they would go sign these returns. Go signing means, so typically when you prepare a return as a preparer, you put your information. So if you're a CPA, you put your information and you sign the bottom of the return as a preparer. Well, go signing basically means that these businesses that were preparing 941X forms on behalf of other businesses, they weren't putting their name on these forms. So it meant that there was a lot of very loose, calculations going on. Businesses were being qualified for the entire period. They were being qualified, using numbers that were not substantiated or done properly. The PPP wasn't being considered. These businesses were receiving their contingency fees and then, kind of vanishing into the night. So it created some pretty significant issues that, really began to reach the ears of the IRS. So one of the things that these third-party providers were doing in particular, so we talked about all the nuance. When the program was initiated back in March of 2020, Congress was sequestered, they were too. Congress was sequestered, but so was the IRS. And in many ways, the IRS is still sequestered today. These third-party providers were very adept at finding loopholes within the program that they could use to qualify people that were dubious in nature. We talked about the two main qualifying criteria. The congressional intent was that businesses qualified into those criteria. The IRS was keen to see that those criteria were followed in terms of the gross receipts from the shutdown test. We had a large amount of third-party providers using other not well articulated and subjective tests to qualify businesses. And those tests included supply chain interruptions. So they were saying, third-party providers were saying basically, hey, listen, if you can't get certain goods, that constituted an interruption to your business and you should qualify on that basis. Well, The IRS was very clear that that was not a qualifying criteria. They have an FAQ about that talks about it. I won't get down in the weeds with some of these, but supply chain interruptions is generally speaking going to be an exception in terms of qualifying, and most businesses won't qualify under supply chain. Social distancing or other CDC or OSHA recommendations. Again, those are guidelines. They are certainly not meant to be impactful. As a test, generally, if you use social distancing, everybody had to social distance. A test that makes everybody qualify is not really a test by definition. So that's another one. Broad, overly general executive orders. I had clients who talked about third-party providers qualifying them based on statements made by the president or by OSHA or by other governmental agencies that were really meant to be guidelines or things that businesses should do overall, but really weren't mandatory in nature. Improperly allocated wages, and of course, incorrect qualifications based on ownership. Based on ownership in particular was an area of abuse because the majority of these third-party providers, because they didn't have a legal or accounting background, didn't fully anticipate or understand the nuance that existed there with the ownership side. So by applying these particular tests to businesses, it created a lot of issues that the IRS began to get very unsettled about, to put it kindly. The IRS over time began to feel more and more like businesses were either having claims filed fraudulently on their behalf, or that businesses were filing improper claims that if the appropriate criteria were applied to the claim, that the business would either qualify for less than what they applied for or wouldn't qualify at all. So following sort of this rise, the IRS began to get very active. And this began in particular in July of 2023. In July of 2023, the IRS began to issue more and more guidance about these third-party providers and more clarification on the qualifying criteria for individual businesses who wanted to avail themselves of the ERC. So to begin with, the IRS issues a dirty dozen list every year on an annual basis, and that dirty dozen list highlights the top 12 issues that the IRS is pursuing for that particular calendar year. For 2022 and 2023, the IRS had the employee retention credit and these third-party providers as their top issue for that particular year. And as part of that, they issued what they called 7 suspicious signs that businesses could use to determine if, in fact, they should be concerned about the claim that may have been provided by these third-party providers. And so to step back for a moment, when the CBO initially projected what the cost would be for the ERC, the estimation was somewhere in the $50 to $80 billion range. Well, through 2024, we have seen over $230 billion in claims filed, primarily by third-party providers, and there are 1 million claims still in the backlog queue at the IRS. So, we've got a large amount of activity in that particular area, and the program itself has exceeded expectations by the CBO by a factor of 5 at this point. And that's why the IRS issued this list. A lot of businesses had third-party providers send them in. They wanted businesses to kind of be on notice and thinking about, well, what are the things, if I'm trying to evaluate my claim and determine if it was done appropriately by this third-party provider, what are the things I should be looking at? What should I be considering? And the signs that the IRS identified are kind of listed here. So too many quarters claims, governmental orders that don't qualify, too many employees, wrong calculations. So we've talked about some of these already. Businesses citing supply chain issues. So that was an area of widespread and rampant abuse in particular. And again, I can't stress that that is not, generally speaking, a manner in which businesses can qualify for the ERC. It just isn't. Businesses didn't pay wages or exist. Of course, that's harder to do with the ERC because, of course, you're basing it on historical returns that you would have filed before the ERC was even a possibility. But, it still happened. And then, of course, promoters, third-party providers telling businesses, you deserve this money. You have nothing to lose. You might as well send it in and just see what happens. Those kinds of things happened, or those types of conversations happen all the time with third-party providers. It's a pretty common phrase that there's no such thing as a free lunch. That's certainly the case here as well. There are very specific qualifying criteria. So, and there are certainly issues or potential penalties or interest with filing an incorrect claim. So the premise or the idea that you should just file as a business and just roll the dice and see what happens with the IRS, it presumes that the IRS is doing the due diligence, which we spoke about earlier. It's just not what they were equipped to do at the time based on policy and on manpower. But it also discounts heavily the idea that there are, in fact, repercussions. So where do we stand now? I mean, that really is kind of at the heart of this whole webinar. What should businesses be thinking about? What's the IRS doing and the other agencies? And what's it going to look like going forward from the perspective of the program itself, the ERC, as it winds down to April of 2025? Well, as I mentioned before, there has been extremely heavy IRS activity. They have published on a almost bi-weekly or monthly basis news releases regarding third-party providers and clarification on collection enforcement activity, new rules. There has been a moratorium on processing claims at the IRS since October of 2023 that has persisted into today. There's no ending in sight thus far based upon what the IRS has signaled in terms of when they're going to resume processing claims. There is this giant backlog that still exists. And the IRS has also indicated that, contrary to what they've done in the past, that there is going to be heightened due diligence on new claims that they process, that the IRS processes. So, in the past, like I mentioned, there was no due diligence. Wages were compared to make sure that they were appropriate, and then refunds were issued. Well, the IRS is going to be asking for documentation up front going forward. They're going to be asking businesses who apply for the ERC to substantiate those claims in a manner that's appropriate to demonstrate to the IRS that the business does in fact qualify. And their processing times are going to go out to 180 days or greater, according to the IRS, which is, we had some pretty long extended processing times in the past. The IRS had gotten down to about 3 to 5 months in terms of processing prior to the moratorium. They're going to push that all the way back out again, and I would anticipate they may be even longer depending upon the amount of the ERC claim and where the ERC claim is filed from. So I mentioned earlier that the IRS had issued a 2023 Dirty Dozen list. This is an example of one of the press releases that the IRS has issued. And as I mentioned, these have been very frequent recently with regards to how the IRS has been communicating and what their posture has been going forward. So I talked about the increased processing time. The IRS did initiate, it has had for a while now, a voluntarily withdraw program. So if you sent in a 941X to claim the credit, you did your homework and you determined, well, I don't feel comfortable with that claim for the credit, you can do this today. As a matter of fact, you can always contact the IRS either through irs.gov or by calling them on the phone, and you can voluntarily withdraw your 941X forms with no harm, no foul. The IRS will do that. They also had a voluntary disclosure program, or VDP, and that program began in the first quarter of 2024. It ran through March 22nd. That program was a nice program because it allowed businesses who felt as though they received refunds based upon the ERC that were incorrect to return that money to the IRS. The IRS would not charge them any penalties or interest, and they would allow businesses to keep 20% of that credit kind of to offset any fees they may have paid to third parties or what have you. So that program ran through March of 2024, March 22nd of 2024. It has since lapsed. There is talk that the IRS may reinstitute it at some point in the future, but that, there's no formal announcement that's been made up to this point. In terms of the claims withdrawal process, just to put some numbers to kind of the activity that we've seen there. So again, we've seen $230 billion in claims approximately issued up to this point. There have been 1,800 entities, I beg your pardon, who have withdrawn $251 million worth of ERC claims approximately to date. On the VDP side, voluntary disclosure side, there have been $225 million worth of refunds that have been returned through that program, 225 million. And then in terms of the IRS's activity itself, in terms of reviewing and denying improper claims, the IRS reports that they have had 12,000 entities that they've identified that have filed over 22,000 improper claims, and that they've sent out assessments in excess of $572 million with regards to those particular claims. So, really truly what these numbers tell us at this point is that the IRS is really scratching the surface in terms of their activity, in terms of enforcement and review of these particular claims, and the issuing of assessments and collections. And then on the other side of it, we have Department of Justice involvement and the IRS criminal investigations departments working together as well to really go after the worst of the worst of both businesses and third-party providers. The IRS reports that as of February 29th of 2024, there have been 386 cases that they have opened against businesses. Really, we're talking about fraud here when we're talking about criminal investigations, and that those claims have totaled $3 billion in the aggregate, and that the Department of Justice has they've secured 25 convictions, and that the average sentencing per conviction is 24 months. So, I mean, there really is some teeth behind these activities. It's not simply businesses or third parties who are, can kind of go, oops, my fault, here's the money back, and then there's penalties and interest. If the IRS determines that there really was some malfeasance or some maliciousness behind claims made by people or businesses or third parties, similar to the PPP, they are prosecuting people. So, it's certainly not something to be afraid of if you've been doing things the right way, but, the IRS and the DOJ are signaling very strongly that they are taking this seriously and that they are going to come talk to people and prosecute where needed. There is in terms of where we're at now, there's a possibility that the IRS will be sunsetting the program. Commissioner Werfel has been talking with Congress. There is a bill in process. We are in an election year. That bill has been stalled in Congress, but it does demonstrate that it is on the mind of our legislature and on the minds of the IRS to try to kind of wrap this thing up as soon as possible. And then there's, of course, I talked about earlier about the DOJ. There is likely going to be involvement of other federal agencies. On the PPP side, we saw sort of the genesis of enforcement starting with the SBA, but that quickly transferred to the Secret Service, and currently enforcement of the PPP lives with the Department of Homeland Security. There is a likelihood that will continue as well, not necessarily with those agencies, but that the enforcement of the ERC will get leveraged out to other agencies as well. So what can businesses do today? If you are a business, you hired a third-party provider to process your claims, what can you do? Well, the first thing that you should do is you should gather and review all of your documentation. You should start doing that now. I would anticipate you should plan for an IRS audit of some kind. The audit will be very narrow in nature. It won't be an audit like you might be used to if you've had your business audited in the past. It will ask you to demonstrate that you qualify and then provide documentation to show the numbers, essentially, to show your work. That's going to be the extent of it. If you start gathering that information now, if and when you get that audit, you can send it to the IRS. They'll take a look, sign off on it, and you'll be on your way. But I can promise you, having worked with clients in the past and done analysis on claims that have previously been made, it is far more difficult to gather this information now than you might think. So it's in your best interest to gather it, and particularly if you use a third party, because you can go and request that information from them right now while they're still around and thinking about it, that might not be possible in the future. So gather information, get wages, gather 941s, 941Xs that were filed, any governmental orders or narratives that you might need. The third party qualified you based upon supply chain or whatever else, have them write a narrative for you and give it to you so that you have it for your file. And again, like I mentioned, it's better to do that now than to wait until kind of later on after the fact when it may be much more difficult to do. I kind of skipped ahead here. So a couple more things to consider before we wrap up and take questions. If you are a business and you did avail yourself of a third party, or maybe you did it yourself, maybe your own accounting team put together a claim for you, it is not, it's never too late to bring in a third party to do analysis for you. A third party who is very experienced and well-versed in the ERC program, understands the nuance, can go through your calculations, they can review your documentation and paperwork, they can take a look at different publications and news releases by the IRS, and they can give you that peace of mind to tell you that, you know, either your claim is good and it would stand up to scrutiny, and here's your kind of response package if you were to be audited by the IRS, or maybe they might tell you you have some risk here. And having that conversation now with a kind of an independent reviewer for your claim can be done at a relatively low cost. And if you're a business, that'll really provide you with that peace of mind that you need, especially as you're starting to see the ERC pop up more and more in these news releases from the IRS and in the news. So, you know, I would advise if you have a claim and you have questions, it's always better to ask those questions now and not to assume that because you're not hearing from the IRS or the third party that did your claim that you're in the clear. So with that, I will turn it over to John for questions.
Thanks, Joe. I will say up front, we did get one question. It's a very nuanced question. We will follow up on that separately after the webinar's conclusion. But now is the time to enter your questions in the queue, and we will address them as many as we can on the remaining time that we have. The hour is flying by. So please do that now in your questions window. The first question I do see, short of the other longer narrative form question, is why was participation in the voluntary disclosure program so low?
Yeah, so I think what that really speaks to is how the participation in the ERC in general got so high in the first place. And that is that we had third-party providers who are really, really active in driving the program. Businesses and business owners are very, very focused on running their business. They're not necessarily looking at federal programs like the ERC to learn the rules or figure out if they qualify or what have you. Third parties really push that out. What hasn't necessarily happened is two major things. The first is these third-party providers are not calling businesses and saying, hey, you should think about these things. Third-party providers have positioned themselves to say, we've done these calculations correctly, you can rely on them, so therefore you shouldn't worry about it. And businesses in response are saying, yeah, of course, we hired you based upon your expertise, real or otherwise, so why would we have to be concerned? We see these things coming from the IRS, these news releases, and we see it in the news, but that doesn't apply to my business because I hired third-party providers. So I hired the experts to do this. That's part one. The second part is that the IRS, you know, while they've been active and communicating out into the general public, what they didn't do is send any notices to any businesses to at least signal to the businesses that they should potentially consider having their ERC reviewed or that there may be any issue. So if you kind of consider that in totality, it's my opinion that really, truly, there's a lot of businesses who are going, well, look, there may be activity and there may be these unscrupulous third parties or these people that have done the wrong thing, but that just doesn't apply to me. The IRS received my claim, they paid it, they haven't sent me any notices, they haven't signaled to me that I need to be worried about it. And furthermore, I have a third party in many cases who did the calculation for me. So I've operated in good faith, I've done all the right things. And that can be, you know, depending upon a lot of factors, kind of mistaken faith in third-party providers and the fact that the calculation was done right. So, you know, how the IRS kind of transitions in terms of how they're going to signal in the future, I think will be very determinative in how we see the program evolve into 2025.
Great. Another question just came in. How many years going forward will the IRS audit the ERC amended, returns?
It's a good question. Right now, the IRS has 4 years from the date that the return was due to audit that particular return. So if you're looking at, since every 941 was filed on a quarterly basis, you just add 4 years from that due date. That's how long they have to audit. Now, as part of the legislation that's being kind of pushed through or being talked about in Congress right now, there is an effort to extend out that audit period. I would expect that there will be some traction in terms of extending out the period that the IRS has to audit, just based upon their feeling that there's so much fraud currently kind of permeating the program, but it remains to be seen what that ultimate number looks like.
Okay, great. Another question. What are your thoughts on filing amended business returns and the applicable individual returns to report the reduction of expenses? The note here is the statute is set to expire on the 2020 returns. Will the IRS have authority to audit if the return is a closed period?
So I'm not totally sure I understand the question, but as I understand it, if you're claiming the credit, you do have an obligation to go back and amend your return. You wouldn't necessarily, the ERC is not driven by expenses, it's driven by wages primarily. But if you're talking about the payroll deduction in particular on your individual tax return, you do have an obligation. The IRS has been very clear on this in subsequent news releases and FAQs that they've published since the ERC first came to be in 2020, that you have an obligation to go back and amend your returns to reduce your payroll deduction and then pay any associated increase in tax that goes along with that reduction.
Great. This person, and we're getting close to time here, but we have time for a couple more here. 2 questions. The first one is the following. Would CPAs be held liable if they charge contingency fees, and the example given is 10% of the credit amount?
So Circular 230 talks about contingency fees in particular, and Circular 230 does create allowances for CPAs and attorneys and preparers generally to charge contingency fees in certain circumstances, and credits are one of those circumstances. So that's my answer to that. In terms of liability for the miscalculation or some issue with the ERC itself, I mean, CPAs in general, and this goes to attorneys or anybody who prepare a return or an ERC claim, you're not responsible if your client lies to you or gives you bad information or what have you. That's certainly not something, that's no different than the regular work that you do. You can't just cover your eyes and ignore obvious signs of fraud or misrepresentation. But if your client gives you information, you also don't have to go back and recreate the wheel to make sure that everything they're telling you is correct. So if they give you information, you request it, you have no reason to think that there's an issue, then there's no liability, or it's the odds of you having liability for an incorrect ERC claim would be, significantly low.
Great. And part 2 of the person's question is, are cannabis companies eligible for ERC credits since 280E is not in effect for payroll, and as such payroll credits such as the ERC, sorry, it's a little rambling, but such payroll credits as they are under the ERC?
So 280E is sort of a separate issue entirely from the ERC itself. Cannabis companies can qualify the same way that any other business could qualify. And for those of you on the phone or on the webinar who are not sure what 280E is, 280E basically says that cannabis businesses are not permitted to deduct ordinary business expenses on their income tax returns as a deduction. So that's not going to be applicable, but I have done cannabis claims in the past, and I've qualified them based upon their status as retail operations. So if we're looking at Michigan in particular, retail establishments for periods of time there in 2020, 2021, where they did have a full or partial shutdown in terms of their ability to serve their customers. Well, many cannabis businesses fall into that category. So, provided that you meet that criteria, those two tests, which are the gross receipts or the full or partial shutdown, the nature of the business itself doesn't really matter. I mean, it needs to be a legal business, of course, but cannabis absolutely can qualify if you have a reduction in gross receipts, let's say, or you had a retail front to the business and you were fully or partially shut down.
Great. And one last question, and I know we're right at time, so if we can briefly answer it, I hope you can. Do you amend any returns if the ERC credit application is still processing, or wait until you deposit the ERC check?
That's a good question. That really can go one of two ways. You do have an obligation to amend your return when you know that the circumstances that are driving numbers on that return have changed. So if you're applying for an ERC, your expectation is that you're going to receive it, and therefore the circumstances that support the numbers in the return have changed, and so you should be amending that return. So, the conservative, safe approach would be if the business qualifies and you send in a 941X, then you should turn around and amend your return. Practically speaking, I mean, you do have some time to kind of wait for the IRS to figure out what it's going to be doing with these types of things. Given the nature of this moratorium, if you were filing a new ERC claim today, I would say it probably wouldn't be the worst idea in the world to, just kind of wait and see what the IRS does with these things to see if they're going to even process anymore. If they signal that they're going to process new claims, then I would go ahead and amend your return at that time.
Joe, we're up against the time, so I want to finish up by just letting everyone know that they're going to receive a pop-up survey when they log off today. We'd really appreciate any feedback that you have, any topics you have suggestions for future events. And the other thing I would like to remind everybody about is that this recording is going to be available hopefully later today, if not tomorrow, so that if you need to forward this on to others that you know or would like to revisit the content again yourself. It will be on our event page on Plunkett Cooney's website, plunkettcooney.com. And one plug for our Don't Bet the Business blog. Joe is a regular blogger. If you're not following our Don't Bet the Business blog, you can subscribe by email, and you'll receive notices when new content's available. A lot of good tax updates going on there as well. So with that, we want to thank you all for attending today's program. And if you're going down for the draft day in Detroit, safe travels, have a good time. And thanks for attending today's program, and we'll see you next time.